My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to discuss the distribution of dividend. So the most important element of the distribution of dividends for you to understand is that dividends are an after-tax distribution of owner's equity. That means that dividends are not an expense that would show up on the income statement like interest expense or something like that. It is in fact a return or partial return of shareholders' equity. That's the key to understanding how dividends are accounted for. What that means is that dividends, since they are not a cost that would appear on the income statement, the dividends have to come out of some other component of the balance sheet, and generally speaking, dividends are going to be coming out of retained earnings. Now, let's talk about how dividends can be distributed and the various kinds of dividends that are typically seen in business today. The most common dividends that are distributed are just simple, straightforward cash dividends. Shareholders, by and large, do not have a right to dividends, particularly the common stockholders, but once the dividend is declared by the board of directors, then a liability is created. And normally dividends are going to, or the dividend declaration is going to create a current liability. Cash dividends are just simply, again, a distribution of cash to the shareholders, and instead of debiting an expense account of some sort, what happens is that retained earnings is reduced directly. We've seen several examples of how retained earnings is changed or altered from one year to the next, and one of the major components of a change in retained earnings is the declaration of dividends. Also, just as a side note, dividends are not paid on treasury stock. Dividends are paid only on those shares of stock that are issued and outstanding. In other words, only on shares that are held by investors, individual investors or institutional investors or whoever owns them, whoever the stockholders of record are. But dividends are not paid on treasury stock. The recording of a cash dividend is actually fairly straightforward. We simply debit retained earnings for the total amount of dividends to be distributed, and then typically we'll credit dividends payable, which is a current liability, or if we are paying them directly, then simply a credit to cash. That's just a matter of timing when the payment is actually made. There are other kinds of dividends that can be distributed. Sometimes we have property dividends or liquidating dividends. Those are increasingly rare, especially for large companies. Large publicly traded companies typically do not declare property dividends or liquidating dividends. Small companies, small closely held companies, can still declare property dividends. The key, though, with property dividends is instead of crediting cash, because it's not a cash dividend, instead of crediting cash, we will just simply credit the asset account for the fair market value of the assets that are being distributed. And so property dividends still reduce retained earnings, and that's the key here. That's the most important part, is that a property dividend is going to reduce retained earnings just like a cash dividend would. It's just a matter of the form in which the dividends are distributed. Liquidating dividends occurs even less often. Liquidating dividends are dividends that are not based on earnings. So normally dividends are being paid out of or distributed based on the retained earnings, the accumulated net income over time. But if we pay dividends in excess of the retained earnings balance, which most companies are not even permitted to do, but there are some circumstances where that can occur, then instead of reducing retained earnings, we would actually reduce paid-in capital. Another type of dividend that occurs on a fairly regular basis is a stock dividend. And in stock dividend, no assets are being distributed, but instead additional shares of stock are being issued to the current shareholders based on some defined proportion. So for example, we may decide to declare let's say a 15% stock dividend. So whatever number of shares you own currently, let's say you own 100 shares, and the company declares a 15% stock dividend, then you would get 15 additional shares. You have 100 shares currently, 15% of that would be 15 additional shares, and the company would just simply send you the stock certificates representing 15 additional shares. That's what's known as a small or ordinary stock dividend. And with a small or ordinary stock dividend, the valuation basis is the market value of the stock that is being issued. So it has to be the same class of stock. If you own 100 shares of Class A common stock, company declares a 15% stock dividend, you'll get 15 shares of Class A common stock. The valuation basis would be the market value of those shares of stock. And so what will happen is retained earnings will get debited for the total market value of what is being distributed. And then since additional shares of stock are being issued, the paid-in capital accounts, the common stock account itself, which is where we keep track of the par value of the stock, and additional paid-in capital, both of those accounts will be credited. So let's say the total market value of what's being distributed, these 15 shares, let's say the market value is $20 a share. That would be $300 would get debited to retained earnings. And then we would need to know the par value of the stock. We'll keep it simple. Let's say the par value is $1 per share. So the capital stock account, common stock account, would be credited for $15. $1 par value times 15 shares is $15 of par value. And then the remaining balance would be credited to additional paid-in capital, which in this case would be $285. The market value of the stock was $20 a share times $15 per share is market value is $300, and so the total credits also have to be $300. It just gets split between common stock and the paid-in capital. The key there is the fair market value of the stock is used as a basis for determining the valuation of the transaction. So retained earnings again gets debited, and then instead of cash or other assets being credited, it's the paid-in capital accounts that get credited. Notice here that nothing happens to the balance sheet in an ordinary stock dividend in net. Retained earnings is reduced, paid-in capital is increased, the net change in shareholders' equity is zero. Retained earnings and paid-in capital group of accounts are both part of shareholders' equity, and so in net, nothing happens to assets, nothing happens to liabilities, nothing happens to shareholders' equity. Stock dividends are issued very often as a way of sort of giving the illusion that the company is providing a return to the shareholders without really providing a real cash return. The other type of dividend or stock dividend that can be distributed is what's called a large stock dividend. And normally the accounting for a large stock dividend is reserved for stock dividend declarations of greater than 20 or 25%. There's no real hard cutoff under FASB rules, but in general we think of a 20 to 25% or more is going to be a large stock dividend. What happens here is it is the par value of the stock issued is used to record the stock dividend, by debiting additional paid-in capital or retained earnings and crediting the common stock account. Once again, the key to understand here with a stock dividend is that nothing changes in net on the balance sheet. We're moving dollars between a couple of shareholder equity accounts, but in total, shareholders' equity is not going to be affected. It's just moving dollars between retained earnings and the paid-in capital group of accounts. So those are the typical kinds of dividends that are being distributed in today's environment. The two most common, cash dividends, that's very easy to account for. We debit retained earnings for the total amount of dividends being distributed and credit cash if the distribution is made immediately, or dividends payable if the distribution is going to be made at some point in the future, which is a more common result. The other typical kind of dividend that can be distributed is what's known as a stock dividend, which is not actually the distribution of assets, but is simply the distribution of additional shares of stock. The two types of stock dividends, a small or ordinary stock dividend, the market value of the stock being issued is the valuation basis, with a large stock dividend greater than 20 to 25% of the number of shares outstanding. It is the par value of the stock that's being issued that is the valuation basis. In either case, though, bear in mind that with a stock dividend, the net change in shareholders' equity is zero.